It is 2:07 a.m. Sorry, my MacBook ran out of storage as I was recording the previous video. So we were busy with example 8. So I was saying that they have 360,000 14% non-redeemable preference shares with a nominal value of 50 Rand each, trading at 45 Rand. So the market value is 45 Rand. So the question is, what is the cost of the preference shares? The way we calculate that is we just figure out what the I guess you can call it dividend is, which in this instance is the 0.14 times 50. So you get 14% and the nominal value is 50 Rand. So for the as far as the investors are concerned, their shares are worth 50 Rand, or I guess that's what they like, what we tell them it's worth, and we pay 14% on that nominal value. And the P of naught, the market value of the share is 45 Rand. So you do that division, you'll get a value of 15.56 or 0.1555. That's the cost of preference shares. Let's go to class example. I called it 10. Okay, so this is how you do the redeemable preference shares without a financial calculator. So the financial calculator gives you an answer of 7.05 if you have the years, the present value, the payment, and the future value. Okay, so it says here, a redeemable limited has 9% redeemable preference shares in issue. The preference shares pay an annual dividend of 9 cents and are currently trading at 1.08 Rand. The preference shares are redeemable at par in 5 years' time. Calculate the cost of preference shares. So they just give you the financial calculator calculation. They don't do it. I will say, I do doubt that a question such as this will be asked, especially if it's part of the component of calculating working average, weighted average cost of capital. They might ask it as a standalone question, which I think is what's most likely. So we have 9% redeemable preference shares, and the dividend per annum is 0.09 Rand. And they trade at 1.08 Rand per share, and they're redeemable at par in 5 years. So what's the par value? So just think about this. If we get a dividend of 0.09 Rand a year, and we get a dividend rate of 9%, it means the par value is 1 Rand, right? Because 9% of 1 Rand is 0.09 or 9 cent. So we know that N is equal to 5. So they say that they're redeemable at par in 5 years' time. And the present value of the shares is 1.08. That's what they're trading at. And the payment that we have to make, the dividend payment we have to make every year is 9 cents. And the future value, the par value, like we're gonna give them, they can redeem the share at the end of 5 years' time. So the way that redeemable preference shares work, or the way you can think about it, is basically a loan from a bunch of people, because they buy the redeemable preference share every year. So you get a capital inflow. Every year you essentially give them a dividend, which is essentially the interest that you give them. And then at the end of the period, you buy back the share from them. So there's a capital inflow, there's interest, there's a capital outflow. So it's just like a loan. You get money, you pay interest on it, and then maybe there's a point where you pay all of it back. Okay, so how do we go about calculating this? So we pay 0.09 Rand a year. And in 5 years' time, we buy it back for 1 Rand, so we redeem it. And the cost of preference share equity is the effective interest rate paid on the quote-unquote loan of 1.0 Rand. So recall from week 2, the present value of an annuity calculation. That is the payment times 1 minus 1 plus I over t to the power negative nt over I over t, where I is your discount rate. So in this situation, what do we need? We don't know what I is. That's the thing. So the financial calculator gives us 7.05. We don't know what it is. So what do? We tell ourselves, listen, when I calculate the present value of the dividends, how do I do that? It's 0.09 times 1 0.09 times 1 minus 1 plus I to the power negative 5 over I plus 1 over 1 plus I to to the power 5 equals 1.08, where I is our cost of capital, right? Or sorry, cost of preference share capital. But we don't know what I is, and it's very difficult to solve it algebraically looking at this equation. So what we're going to do is we're going to plug in a couple of values, find the range within which the actual I lies, and then we're going to interpolate. So note here, the present value of the dividends plus the present value of the redemption has to be equal to 1.08, because 1.08 is the how can you say, it's the market value or the future value. So cool. Or another way to think about this, basically, when I present value my dividends and I present value the redemption, that has to be equivalent to the 1.08 that the shares are worth. And so it's 1 over 1 plus I to the power 5. It's 1 because we're going to redeem it for 1 rand per share, but we need to discount that by 1 plus I to the power 5. So let's calculate I of 8%. Plug in 8% or 0.08, you get 1.0399. Then you can plug in 7%, and then you get 1.082. So what this tells us is that what we want, which is 1.08, is between 1.0399, which is correlated with the interest of, or the cost of equity of 1.0399. It's between 1.0399 and 1.082. And so I is between 7% and 8%. So don't get confused. 7% is attached to the 1.082. 8% is attached to 1.0399. So what's the net present value range? So there's two ways of doing this. I'm just going to quickly say, if you say 1.082 minus 1.0399, then you're going to get 0.0421. So that is the way that I did it down here with the OR. So 1.082, which is associated with 7%, minus 1.0399, which is associated with 8%, 0.0421. So that's the range. That is basically to say, when I go from 7% to 8%, what is the change in net present value? What is the change in like the combination of the present values of the dividend and the redemption? So now what we do, to get from 7% to 8%, there's a change in net present value of 0.0421 negative. And to get from 7% to X%, there is a change of net present value of 0.02, also negative. Why is that? Because look here, we have 7% has this value of 1.082. If we could just reduce that value by 0.002, then we would get to our 1.08. So we know 7% is already quite close. We just need to get a little bit closer. Okay, so what do we do? So we say, what do we want? The change in net present value, 0.002, divided by 0.0421 times 1% is 0.0475%. So another way to think about this is, for example, if the change from 7 to 8% in terms of net present value was 1, and what we wanted it to be is 0.5, then we would just say 0.5 over 1 times 1%, and that would just be 0.5%. But in this instance, we want to see, 0.002 is the fraction that we have, and we want to see what percentage it is of 0.0421. So it's 0.0475%. So that is to say, if we just increase the value of 7 by 0.0475, then we will get to, and you can put this in your calculator and double check, we will get to the 1.08 value that we wanted. If you put it in a financial calculator, you get 7.05, sorry, not 6. So that's how you do the redeemable preference shares without a financial calculator. Okay, class example 9. Okay, so QT Limited has 2.2 million non-redeemable 11% 100 Rand debentures in issue. The market value, or they're currently trading at, so they have a market value of 90 Rand per debenture. The tax rate is 28%. What's the cost of the non-redeemable debentures? Much easier to calculate. So in this instance, we say I times 1 minus t over the market value in year naught. So obviously I times 1 minus t, because we have to like subtract for tax. So we multiply by 1 minus 0.28. We divide by the market value, which is P0. Now, for I, just have a look here. I is going to be the 100 Rand debenture issue multiplied by 11%. So the 11% or the 11 Rand is your payment every year. So 11 times 1 minus 0.28 over 90. That's going to give you 0.088. That's going to give you 8.8%, right? You don't want to use 0.11 on top, because then you're going to get a very, very small value. So that's why you use 11, because what you're calculating is every year, okay, how much as a fraction of the original market value of the debenture am I paying in interest payments. So when you want to calculate that fraction as a percentage, you say I am paying 11 Rand in interest payments on these debentures. I am adjusting for a tax of 28%, and then I divide by 90. That gives you 8.8%. Okay, let's do redeemable debt. So it's the same logic as the previous one. I'm not going to spend too much time on it, but the nominal value is, so you have 8% redeemable debentures. They have a nominal value of 100 Rand each. They have a market value of 90 Rand. They are redeemable at 105 Rand in 5 years, and T equals 28%. So what is the cost of debt? So here we need to have the present value of interest payments plus the present value of the redemption of these debentures equal to 90 Rand, because 90 Rand is the market value. It's what they're trading for, right? And so how do we calculate this? So obviously we have, 0.08 times 1 minus 1 plus the cost of debt, which we don't know, to the power -5 over the cost of debt plus 105 Rand over 1 plus the cost of debt. Sorry, I'm being stupid. I was correct. So the reason why this is 8, sorry. Can I change this? It doesn't want to change. Okay. The reason why that is 8 is because, what is this? Because it's a 8% redeemable debenture and the nominal value is 100 Rand each. So the payment that we make every year is 8 Rand. Yes, that's why. So it's the payment times the formula plus again the 105 Rand, which is what they redeem it for, and then we present value that by 1 plus the cost of debt, which we don't know, to the power 5. We need that to be equal to 90. So just looking at the timeline here, so in year 0 we get 90 Rand because cool beans, we are or that is what we are, what they're willing to give us. So the nominal value is 100 Rand, but they're trading at 90 Rand. So the actual value that people are willing to pay is 90 Rand, because that's what they're trading for. If we asked for 100 Rand up front, they would just go to someone else. So let's try 10%, plug it into the formula that I showed you over here, and the value you get is 95.53, which is not equal to 90. Try 12%, you get 88.42, which is not equal to 90, but now it's good because you've got a range. So what we want is 90. So 88.42 is less than 90, and 95.53 is greater than 90. 95.93 is associated with the 10%, and 88.42 is associated with the 12%. So we know that the thing that we're desiring, the cost of debt, is between 10 and 12%. So now we calculate the net present value range. So 95.53 minus 88.42 is 7.11. And I equals 12% gives us a value that is 1.58 away from 90, because 12% gives us 88.42 in the calculation, and that is 1.58 away from 90. So the adjustment is it's the 1.58 that we want over the 7.11, which is the total range, and we multiply that by the difference, which is 12 minus 10%. So you'll remember the previous question, we compared 7 and 8% So it was just 1%. Now we're comparing 12 and 10%, so it's 2%. So 0.222 times 2% is 0.444%. So the pre-tax cost of debt is 12 minus 0.444. Why do we subtract 0.444? Well, when you have 12%, you get 88.42. And when you have 10%, you get 95.53. So that tells you lower costs of debt give you higher values, higher costs of debt, higher interest rates give you lower values. So the problem with 12 is that it gave us a value which was too low. And the problem with 10% is it gave us a value that's too high. So if we want 12% to result in a slightly higher value, we have to reduce 12% by a little bit. And so when we reduce it by 0.444, we get 11.556%. And then important, this is a debt. So your cost of debt, you have to adjust for tax. So then we say 11.56 times 1 minus 0.28, you get 8.32%. I think in a financial calculator, you get 8.31%. Okay, let's move on to the next example, class example 10. If I can find it. So what they do here is a very simple weighted average cost of capital according to the target capital structure. Plug and play. So they tell you what the target capital structure is. Those are your weights, 0.6, 0.3, 0.1. Easy peasy, the denominator adds up to 1. And we know that the before tax market related cost is given as 14, 10, and 11%. So just plug in those values and you'll get 11.66%. So they're basically saying, we've got the target capital structure, weight my ordinary shares by 60%, weight debentures by 30%, weight preference shares by 10%, because that's the desired capital structure. Of all the capital we have, 60% of it has to come from ordinary shares. So when you now give me the weighted average cost of capital, you have to weight 14% by more than 11%, because 14% is 60% of the total capital source, whereas preference shares 10%, which costs 11%, is only 10% of the of how our capital structure is financed. Let's go to class example 11. So this is now just slightly different. So all that we're doing now is this time we don't have decimals. We're using the market values, I believe. So you'll see the market values in thousands of rand over here. We're not using the book values because we're not weirdo virgin accountants. So the market value, is 137,000 rand and the cost is 14,000 rand. So here's our formula, the cost times the value. So sorry, I've been using the word weight when I mean value, but you can think of them as almost the same thing, because what you could also do instead of doing it like this is, for example, if you wanted the quote unquote weight for ordinary share capital, you would just say 137,000 over the total market value. So 137,000 over 137 plus 36 plus 14,600 would give you the weight for ordinary share capital, and then you could just divide everything by 1. But in this example, we just use the values. So we say, for example, for ordinary share capital, 0.14 times 137,000. For preference share capital, we say 0.1 times 1 minus 0.28, remember, tax, multiplied by 36,000. And then for debentures, it is 0.11, that's the cost, times 14,600, that's the value. We divide it by the total value, we get 12.46%. And then class example 12. So QT Limited has 2.2 million non-redeemable 11% 100 Rand debentures in issue. The company has to pay flotation costs of 1% on the issue of these debentures. So that's Janet, that works at JSE, that we have to bribe to get us to issue the debentures. Not bribe, it's finance is all about ethics, as we know from 2008 and Enron and all the businesses in the world. They're always super ethical, especially the stock market. That's where ethics go to thrive. So the company has to pay flotation costs of 1% on the issue of these debentures. Similar debentures are currently trading at 90 Rand per debenture. 90 Rand, that's our market value. The current tax rate is 28%. Calculate the cost of non-redeemable debentures. So this is non-redeemable, so it's easy. We don't have to stress. So how do we do this? So the cost of debt is the interest payment, which is 11% of 100 Rand, which is 11 Rand, and we multiply it by 1 minus 0.28 to get the after-tax cost. And then on the bottom, you'll see that we have our P0, our market value of 90 Rand. That's fine, but we have to multiply it with 1 minus 0.01 because there's a flotation cost. Remember, there's Janet. Janet is charging us 1% for us to be able to like launch these debentures and to issue them. So then we have to reduce the value that we actually get. So instead of receiving that 90 Rand from everyone, we only receive 99% of 90 Rand. So the cost of debt is 8.89%. And this is intuitive because think about, for example, if the floating cost was 0.5, it would the numerator would be smaller because it would be 90 times 0.5 instead of 90 times 0.99. And so then our cost of debt would be much higher. So just intuitively, I hope you understand the whole thing of floating costs. So in the test, just think about Janet. However you picture her as looking. I picture her as being like very professional and a hustler, boss girl. Is that the word? Boss, girl boss, that's the word. Class example, Iron Limited wants to issue a bond in perpetuity with a face value of 100 Rand and a coupon rate of 10%. Payable annually. The market-related yield to maturity for similar bonds is 11%, and similar bonds are selling for 90.91. That's our market value. Determine the component cost of a new bond issue if the flotation costs are 1.82 Rand per bond. So Janet is back at it again. So how do we solve this? A cost of debt, generally when we have bonds or perpetual debt thingy key, is we just take the coupon that we pay, we divide it by the market present value, whatever, of the bond. In this instance, we have to subtract 1.82 Rand. So they give it to us in Rand values. It could also be a percentage where you would just multiply by 1 minus the flotation cost percentage. So then we would say the 10 Rand coupon rate divided by the 90.91 Rand market value minus 1.82. That gives you 11.22%. Let's do example 14. Class example 14. Hyper Limited would like to fund a new project. They want to issue 9% non-redeemable preference shares. Thank God, no need for interpolation. The preference shares pay an annual dividend of 110 Rand and are currently trading at 1,000 Rand. The firm pays flotation costs of 20 Rand per share. So required, calculate the cost of preference shares. How do we do that? So D is 110 Rand because this year, next year, the year after, the dividend will stay constant, 110 Rand. P is 1,000 Rand. Why is that? Because that is what they're currently trading for at 1,000 Rand. That's what the shares are trading for. The firm pays flotation costs of 20 Rand per share. Janet is back at it and she is chowing us with her flotation costs. So now when we do the cost of preference shares, it's very simple. In perpetuity, you would usually just say the dividend divided by the market value of the share. That would just be the percentage, I guess, cost of the preference share, because for example, if it's 10 Rand dividend on 100 Rand share, the cost of preference share, equity, capital, whatever, is 10%. But now it's 110 Rand, which is the dividend. The market value is 1,000 Rand. We have to subtract 20 Rand. And so in this instance, the final value for the cost of preference shares, which we have also had to factor in flotation costs, is 11.22%. So let's do class example 15. So class example 15. Kaiser Limited wishes to raise equity capital by means of a rights issue. The ordinary shares are currently trading at 20 Rand per share, and the entity plans to issue new shares at 18 Rand per share. The flotation costs are 2%. Management wants to determine the company's cost of equity if it pays a dividend of 1 Rand, which is expected to grow by 10% in the future. So what do they want from us? The company's cost of equity if it pays a dividend of 1 Rand. So we know that our ordinary shares have a market value of 20 Rand per share. Cool. The new shares, we are issuing them for 18 Rand a share. And the floating costs, Sister Janet, are 2%. The dividend that we're going to pay every year is 1 Rand, and the dividend will grow by 10% forever. The cost of equity in this example, because it's equity capital, is we grow the dividend. So the dividend in year 0 is 1. We multiply it by 1.1 because that's the growth rate. And then on the bottom, we have the value of the share in year 0, which is 18. Now, I think the reason why I use 18 instead of 20 is because if the ordinary shares are trading at 20, you can't sell ordinary shares that are similar for 22 Rand. But when you issue the new shares at 18 Rand per share, that's what people are buying them for. So that's just your P of naught. You must ask yourself, what is the company actually receiving from the issue of these shares? So then you take the P of naught and you multiply it by 1 minus the fixed cost percentage. So multiply by 0.98, you get a cost of equity of 16.24%, which would be higher if it wasn't for Sister Janet. But we all gotta hustle in this life, so we can't blame her. Class example 16, Jersey Limited is raising new ordinary share capital by making a rights issue at 38 Rand per share. The company has just paid an ordinary dividend of 3 Rand per share, and this is expected to grow forever at 8% per annum. The flotation costs are expected to be 0.97 Rand. Calculate the costs of the new issue of ordinary shares capital. So it's 38 Rand per share. That's what we're gonna issue it. That's what people are gonna pay it for it. We have just paid an ordinary dividend of 3 Rand per share, which will be 8% higher next year. And Sister Janet, once again, is charging us 97 cents per dividend issued or per share issued. So the cost of equity is just, let's grow our dividend from 3 Rand. We multiply it by 1 plus 0.08. Then on the bottom, we have our P naught. And in this instance, P naught ought be 38 Rand. We subtract our floating costs, Sister Janet, once again. And then we get 16.55%. I just want to check something. Oh, sorry, I got confused. 0.97 looks like it's a percentage, but the flotation costs are a fixed value of 0.97 Rand. So everything is fine. And then the last question, mashallah, we're almost done. And then this question is about just a whole long whack question, weighted average cost of capital, to put the concepts together. So the ordinary share equity that we have in this question is we have 2,000 shares with a par value of 75 cents. So it's 4.5 Rand a share in terms of market value, and the dividend paid out in year 0 is 30 cents, and we have a growth rate of 8.5%. In terms of our preference share equity, we have 50,000 non-redeemable preference shares with a par value of 3 Rand, a dividend of 14% per year, and a market value of 5 Rand each. In terms of debt, we have 1,320 non-redeemable bonds that are 12% rated that are worth 100 Rand. And the market value for these is 90 Rand. So that's what we can actually get. And so the loan that we also have on hand is 150,000. We are charged 13% per annum, and obviously we have to think of tax because this 13% per annum that we're paying, we can deduct it from tax. So we have to be careful. So how do we calculate the cost of equity? So we just grow our dividend. We divide by the price of the share, and then we subtract the floating cost. So I think you'll find here, Janet did not find a way to, make some money off of our ordinary share equity. So the fixed cost is just, well, the floating costs is just 0. So we get on the denominator the full P naught of 4.5. That's what the ordinary shares are currently trading for. So 0.3 times 1.085, we grow it by 8.5% divided by 4.5 plus the growth of 0.085 gives us 15.73. That's our cost of equity. The cost of preference shares, again, luckily Janet, she was not around on that day. So we managed to issue it without having to pay her standard commission. So we have a dividend divided by the P naught. So the dividend we said is 3 and the growth is 0.14. So this is D1. So D1 is 3 times 0.14. And then on the bottom, can I add this in? There we go, D1. And then on the bottom, P of naught. So we are told that the market value of the preference share is 5 Rand each. So the par value is what we use when we want to ask ourselves, what did we promise to pay people in terms of a dividend? So the par value of 3 Rand is what we use when we calculate the dividend. and the market value of the preference share is what we use for P naught. That gives us 8.4% cost of preference share equity capital. Then the cost of debt in terms of the bonds. So we ask ourselves, the 12% bonds that we have are on these 100 Rand debentures. So 12% of 100 Rand is 12 Rand. So that's what we pay them every year. And then we multiply that with 1 minus the tax, which is 0.78, and we divide by the market value. So similar bonds are currently trading at 90 Rand. That's why P naught is 90. So we get the cost of debt for bonds of 9.6 Rand, 9.6%, and that's after tax. The cost of debt for the loan is very simple to calculate because we're just trying to figure out how much we pay them. So yes, we pay them 13% interest rate, but we multiply that by 0.78 to take into account tax. That gives you a cost of debt of 9.4%. And so just go and plug all of this into your formula, and you will get a weighted average cost of capital. If there's anything that you're not sure of, just I don't know, go to the slides. It's 2:38 a.m. I hope this video was useful. I hope by the end of this part 2, all of you will have understood what's going on in week 7, albeit it might have felt a bit like cramming. I just want to go back to, I think there was a specific question that I was unsure of, where a specific value came from. I had promised this in the one question. Never mind. You guys are just gonna have to figure that one out. But I think I did explain it in the other video, why when you issue, I believe it was a question about when you issue new capital above the breaking point, why you use a different rate. And I believe it's because when you have to look at the retained earnings rate for when you don't have to go above the max breaking point, and when you do go above it and you have to issue new shares, you have to look at that cost of equity. Sorry if that's a bit random, but I did mention that in the one video and it slipped my mind. But I mean, I think you guys will be able to figure it out. So yeah, good luck with the test tomorrow. Well, today it's 2:39 a.m. And yeah, I believe in you.